Okay, very good morning. Hope everyone had a great weekend. So Monday the 23rd of January, and let's just have a quick run through of the weekend's press, some of the things that we're looking at this morning and for this week as a whole. And starting off, looking at the DAX this morning, a bit of a gap lower in the reopening of futures trade, the cash open causing that usual or regular pickup of activity straight down to S2 before seeing a bit of a bounce. It's becoming a bit of a regular pattern that in terms of a bit of a flush lower in the futures as cash gets underway, taking the price action to its nearest kind of logical point, psychologically down at that S2 this time before seeing then a pretty decent bounce. There's not been a lot in terms of, I'd say, individual single stock equity news to really weigh on that move. More so, you probably had, if you watched the news over the weekend, a lot of unrest, I would say, across several major cities in the US about, mainly women striking over Donald Trump now being in the White House. Their feelings about that very evident, and still some nervousness, I guess, which we're going to talk about shortly, about now that Trump is actually in the Oval Office. And how the market might trade accordingly in the days, weeks and months ahead. I think it's definitely going to be still one of the main drivers. Elsewhere then, with that, the dollar is also a little bit weaker. The dollar index is down about 0.45%. So looking on the top left of my charts, both Eurodollar and cable are quite firmly into positive territory. Some minor outperformance in the cable pair, up 64 at the moment, having got around 15 pips shy in the futures of that 125 handle. But if you look in terms of the overnight session, same case really with the euro-dollar pair, elevated on the back of the weaker dollar. So definitely worth keeping an eye on the greenback. Gold also then, in the kind of mild risk-off sentiment, is positive $8, top right corner, trading at 12.13. This is a 2-month high at the moment. So investors very much avoiding risk after Donald Trump's inauguration. So let's just take a quick run through of the news then. A couple of things I want to talk about. Starting off with the pound, because this week is an important week for sterling currency, and that's going to come into most sharpest focus really tomorrow. So let's just have a quick look at the chart first so you can see where we have been over the last week. It was obviously, this time last week we were down here. That was kind of the conversations we were having after the big gap lower on the back of those weekend press reports about leaving the single market. You then had various comments, the targeting that the dollar's too strong from Donald Trump, helping lift prices, price pressures from an inflation point of view kicking in, Theresa May's well-received speech causing that biggest intraday rally in the pound and cable that we've had in 8 years. And now we've broken above in overnight trade, in Asia trade here, those highs really that we're seeing on the back of when she was speaking. So we still remain relatively elevated here, but some of the conversations I've already had with some of the guys here is just about having today specifically some realistic targets if you are looking at any potential cable trades. That's because a lot of, I'd say, larger order flow or institutional size flow in the currency may well be sitting on the sidelines waiting for tomorrow. Reason for that is, of course, because tomorrow we have the Supreme Court Brexit ruling. There's no set time I've seen for that at the moment, but if I think back to the UK High Court, that came out just after 10 o'clock London time in the morning. So just a quick summary, the Supreme Court verdict on whether the Parliament in the UK needs to vote prior to the government triggering of Article 50. Should there be no change from the High Court ruling, then May would be forced to rush a brief bill through both houses in order to prevent any delay from self-imposed late March deadline. So there's going to be a lot of people, I'd say, sitting on their hands waiting for that verdict just to play out. Now, some of the other weekend press that you probably saw, there was quite an interesting article in the Observer talking about this exact situation and the timings at the moment. And they're talking about a cross-party group of UK Parliament members seeking to stop Theresa May from carrying out a hard Brexit. So how this is structured is that lawmakers from Labour, the Lib Dems and Green parties, and even some of May's own party, the Tories, are in talks ahead of this ruling tomorrow on whether Parliament needs to vote on triggering Brexit. If the court rules a vote is required, the MPs will seek legislation to block May's proposed strategy for Brexit. So there's definitely the possibility that even with that vote, if it goes to the fact, like the High Court, that it needs to be ratified by the House, Theresa May then has a pretty tight schedule in order to push through a new bill to get those houses to vote in order to prevent any delays. But this could be delayed by this situation, where these lawmakers might already start to hinder her plans by looking to take some of the hardness out of her Brexit stance at the moment. So with all this, all it will mean is that I think it'd be a little bit more cautious on timeframes of holding any cable trades if you're looking at that specifically today, given I feel that a lot of people will be erring on that side of being a little bit more realistic in the timeframes of being open in a live trade of what they're going to get out of targets in that specific pair today. Once Tuesday goes, then obviously it's all fair game from there out. And then in the interim period as well, we've obviously got to be monitoring the dollar, which on the back of Trump continues to be really the predominant driver, more broadly speaking. And this morning, the dollar index is already down 0.5%, consequently with both pairs then on the front foot in early trade. So that's the big thing for the pound. Looking elsewhere, quite a few comments oil related that are worth keeping in mind. OPEC and non-OPEC names continue to be very vocal about the facilitation or implementation, I'd say, of the predefined cuts that they agreed. So you've got the Russian energy minister, Alexander Novak, saying global oil prices at between $50 to $60 is what he foresees in 2017. Now that comment, I think, just pretty much solidifies much of the market thinking that if we look at oil on a slightly longer dated chart, it's really that $50 level up to 60 that we're looking at to define any type of price action over the near-term horizon in the coming months. Looking at where we are at the moment, we've kind of been more defined by an even tighter range of really $50 to $55. And from here, I'd imagine that these oil-producing nations with clout like Saudi and Russia will continue to do what is necessary to keep it within that price trading band. So certainly over the next 6 months or so, that's what I would be expecting. Saudi's oil minister also commenting on Sunday that OPEC and non-OPEC oil producers were complying with their pledge to lower oil output and that global oil inventories could be taken back to their 5-year average by mid-year with full compliance. Again, this is important because if you remember the chart we shared with you last week where you had the historical going back OPEC quotas since 2005 and how these oil producing countries have never really stick to that definitively. They've always pumped more, i.e. making more money from pumping higher amounts than actually what they were supposed to, but this time in order to get the actual action of it having an impact on the supply in the market, they're all sticking to it to help prop the price up for the time being. So the oil situation is still worth monitoring, but they seem to be sticking to the script. From the inventory side, of course, we'll be looking out for the Genscape number later on this afternoon, 3 p.m, with the APIs to follow Tuesday and DOEs on Wednesday. The other thing, though, to look at really is Trump. And there's a couple of things that I want to share with you that I've been looking at this morning. And one thing is that you probably hear us talk about from time to time is the VIX, which is the volatility index. Now, the VIX has been trading at extremely low levels given the amount of potential, I would say, macro hurdles that we need to cross over the coming months, whether that be political mainly in the likes of European elections coming out of the Netherlands, out of France, Germany later this year, still possibly an Italian situation, and then also with Trump, that implementation risk we talk so much about as well. But the VIX has really not seen much reaction, and it's been trading at multi-year lows. But one thing that was drawn to my attention this morning was the VVIX, which is basically the instrument to trade. The VVIX index is an indicator of the expected volatility of the 30-day forward price of the VIX. So you're betting on the volatility of a volatility index, so to speak. And the reason why this was interesting is because I saw this chart this morning. And we've talked about how the markets, since the US election on the 8th of November, up until really the end of 2016, we've seen a phenomenal rally in US equities, big lift in the dollar and US yields. Question mark now is that Trump, now he's been inaugurated, he's in place, is what happens now. And the reason why I'm looking at this ratio of the VVIX, or volatility of volatility relative to the VIX, is that has been creeping higher. Really, it's at its highest levels now that we're seeing since the financial crisis. And we're seeing also, the chart on the right, the weekly flows from global financial stock funds has turned negative. So there's been outflows out of financial funds. Now, if you look at where that has been, and if you look at the sector-related performance of Trump, financials have been some of the biggest beneficiaries of the fact that, well, a couple of things: the deregulation of the financials, i.e. the Dodd-Frank rules being watered down. Whether or not that will be achieved is a different conversation, but certainly that's helped the financials. If the economy does get a fiscal element or related boost to an already underlying fairly robust US economy, then that means that interest rates ultimately will need to rise, margins will improve for these bank stocks, and they benefit from that also. But what you're starting to see now, I think, is some subtle signs that the market, now that Trump is in play, is starting to price in a little bit of a reality of the Trump implementation risk. That being that the Trump trade that we've seen evident over the last few months gets reversed. So people taking out hedging strategies against impending volatility, people coming out of investing in the financials. And if you look at gold's been up about 6% since the end of 2016. Obviously, Piers was talking about it at the time. I'm unsure of the exact level of where he executed it, but quite rightly so, and the perfect timing. It was almost this going into this year. Once he's in now, people are starting to fret and have a degree of uncertainty starting to set in about actually how does this play out realistically. And we've already seen gold rally from these kind of well below 1150 levels, more towards 1120, and all the way up to where we are at the moment at 1212 trading this morning. So as I say, volatility or protection against future volatility increasing, financials now reversing some of those gains, gold being supported. And if you look at a few other things here, here's just to put it in a bit of context, gold performance in a presidential transition year. You can see that aside from Reagan and Bush going back into the 80s, actually gold has generally moved higher in a presidential transition year on a historical basis. It's already up for 2017 under Trump. It was up sharply, obviously, during the financial crisis when Obama took over. 2001, obviously the transition there with Bush, and then Clinton as well in the early 90s. One of the other interesting things as well has been that we talked about this last week. US earnings have really gone largely unnoticed. But one thing I was reading at the weekend was they've done basically an analysis over every time the accounts get published for a quarterly earnings report, the company also holds a conference call for their investors, which analysts and single stock traders will also listen to. What's been quite interesting here is that of the 42 S&P companies in the S&P 500 that have reported so far, 27 have cited the term Trump or the administration during their Q4 earnings calls. So the biggest of which is tax policies, the next regulation, the next trade policies. So you can see here as well, from a corporate American point of view, there is also a kind of a degree of uncertainty on their ability to be able to forecast the future on the back of the uncertainty surrounding how this Trump administration will play out in the near term. So a couple things there to think about. Certainly, I don't think you need to guess then what I'm suggesting by what I've been pointing out, is that I feel as though that could be a bit of a return or reversal, of which was more or less, I guess, a case of timing of when this was really going to start to build in. But I think that's been defined by the inauguration, because now he is underway, his team are in, and there's going to be a couple of things to look out for on that front this very week. That being that the White House spokesman, Sean Spicer, I'm sure you've read some of the comments that he made over the weekend, I think it was, at the end of last week. I think the papers were saying he told 4 lies in 5 minutes, which was a new record for a presidential spokesman, about the number of attendance at the inauguration. That was just one of the things, and so on. But he did confirm that the Canadian PM is going to be meeting with Trump in the coming days, but arguably, and actually timing is quite key here, we've got the Supreme Court ruling coming on Tuesday for the UK, and then attention will turn to Friday's meeting in Washington between the President and the UK Prime Minister Theresa May, where they're talking about their possible future trading relationship. So don't forget, we just talked about the fact that this ruling, there's already been some, let's call it, backbench talk of various other parties looking to try to sculpture a deal that Theresa May's hard Brexit plans. But she may have some strength in her side of trying to get her own internal domestic house in order if she can have some positive talks with Trump on the trade front for sure. But she's been pretty stern at the weekend. Obviously there was those protests about Trump's behaviour towards women. Theresa May's been very firm and direct on her view on that, so it'll be interesting to see how that plays out when they meet on Friday as well. A quick look then at the schedule for today. Today, in fact, is a particularly dull day in terms of scheduled events. There's really nothing scheduled. I mean, you've got the Bundesbank monthly economic report that comes out at 11 o'clock this morning, but ultimately I'd say that that's not really typically a market moving event. Could be something interesting to watch, should be any commentary surrounding the inflation element. But otherwise, if we just bring the week over put it into context, on Tuesday we get the various flash manufacturing and service PMIs, that then layered over with that Supreme Court hearing on Brexit, with also a fairly busy US data afternoon, means that Tuesday definitely is going to be potentially hold a lot more catalysts for market movement. Wednesday you get one of the main German data economic releases, the IFO business climate, with the oil inventories in the afternoon. Thursday you get UK preliminary GDP. Quite a few people talking about this in weekend press articles about the fact that most economists' expectations are, as we go through 2017, UK growth will continue to grow, but at a slowing pace going forward, as the real kind of net effect of the depreciation of the pound, which has helped elevate UK economic data really ever since post-Brexit period, starts to dissipate. And we've started to see that in some economic data pieces more recently, none other than retail sales we had at the end of last week, which was I think it was a multi-year low, and it was the third largest decline I think that we've had on record, I think it was. Other data points then going into Friday, obviously Theresa May and Trump meetings, but you get US advanced GDP, durable goods, University of Michigan, and that Baker Hughes rig count is drawing a bit of focus. I think it was up fairly substantially actually on Friday. Did see a minor move to the downside when it came out in crude oil futures. So that's also to keep in mind with US output being of interest given the upward moves we've seen in operational rig counts. So certainly today's fairly quiet on the set calendar, and things definitely start to pick up tomorrow. So keep that in context with your strategies that you may be formulating today about what it is that you're expecting to get out of the market, without the exception of anything unexpected occurring. I'd say you could be in for a more range-bound type day, so identifying, picking your technical levels will be of the utmost importance. And then as to will be having discipline and realistic targets on those trades. Okay guys, going to leave it at that. So enjoy the session, and I'll see you in the chat room later. Thank you.